There is a $1.7 trillion financial weapon pointed directly at the heart of the American 401k system, and the timer is ticking down. This massive liability is not theoretical. It is a very real mountain of debt currently sitting in the pension funds and retirement accounts of millions of unaware workers. If you have a retirement plan, a life insurance policy, or a seemingly safe target date fund, you are likely exposed to this unregulated credit bubble right now. The danger we face does not come from a stock market crash or traditional bank failure, but from a shadow banking system that operates entirely in the dark. It is a system that has quietly grown larger than the subprime mortgage market was in 2008, yet it functions with almost zero federal oversight or transparency. We are talking about private credit, a sector that has effectively become the lender of last resort for the most desperate parts of corporate America. And right now, the risky companies that borrowed this money are hitting a concrete wall of insolvency that threatens to wipe out decades of savings. This is the story of how a decade of artificially cheap money tempted pension managers to gamble your future on junk debt. And it is the story of the complex accounting tricks being used at this very moment to hide the catastrophic losses from the public eye. But before we expose the specific mechanism that is draining the liquidity from these massive funds in real time, please make sure you are subscribed to the channel and have the bell notification turned on so you do not miss the truth about this unfolding crisis. And comment down below with the word safe or risk to let me know if you trust your current retirement strategy in this economy. To understand why this crash is mathematically inevitable, we have to look closely at where this mountain of money actually came from. After the global financial crisis of 2008, regulators clamped down aggressively on traditional banks like JP Morgan, Wells Fargo, and Bank of America. They passed strict laws that made it incredibly difficult for these banks to lend money to risky, debt-heavy companies that might fail. But the demand for debt did not disappear just because the big banks stopped writing the checks. The desperate companies still needed cash. Into this massive void stepped the shadow banks, private equity firms, and asset managers who play by a completely different set of rules. They created private credit funds to lend directly to these risky companies, bypassing the regulated banking system and its safety nets entirely. For the last 10 years, this seemed like a genius financial move because interest rates were pinned at 0%. Pension funds were desperate for yield because safe government bonds were paying almost nothing to support their retirees. So they poured billions of dollars into these private credit funds, seduced by the marketing promise of steady, high returns with low volatility. They were told that these loans were safe, stable, and immune to the violent volatility of the daily stock market movements. But that safety was a dangerous mirage built on the singular assumption that interest rates would stay low forever. When the Federal Reserve began its historic rate hiking campaign to fight inflation, they shattered that assumption and broke the model. Almost all private credit loans have floating rates, meaning the interest payments rise automatically and immediately when the Fed raises rates. A company that was paying 5% interest a few years ago is now forced to pay 12 or 13% today. This massive spike in debt service costs has completely destroyed the profit margins and cash flow of these borrower companies. Thousands of mid-sized American businesses are now zombie companies, earning just enough revenue to pay the interest on their debt and nothing else. They have no money left over to hire workers, invest in new equipment, or build a cash cushion for the coming recession. In a normal free market, these companies would go bankrupt, and the bad debt would be naturally flushed out of the system. But the private credit market is not a free market. It is a manipulated ecosystem designed to hide failure at all costs. The fund managers know that if they let these companies fail, the pension funds will panic and try to pull their money out. So they have deployed a dangerous accounting trick to keep the game going a little longer and mask the insolvency. It is called payment in kind, or PICAI, and it is the financial equivalent of toxic waste hiding in a balance sheet. When a borrower cannot afford to pay the monthly interest in cash, the lender allows them to flip the PIK toggle. This lets the company pay the interest with more debt instead of sending actual dollars to the lender. The lender adds the unpaid interest to the principal balance of the loan, and the total debt burden grows larger every month. Crucially, the lender then records this unpaid interest as phantom income on their quarterly financial statements to investors. They report to the pension funds that the loan is performing perfectly and generating a high yield, despite the lack of cash. But in reality, the borrower is insolvent and the income is just paper money that will likely never be collected. The International Monetary Fund has explicitly warned that this practice is masking the true default rate of the entire U.S. economy. If these loans were marked to their true liquidation value, the default rate would be significantly higher than the official numbers suggest. But because these loans do not trade on a public exchange, there is no market price to prove the managers wrong. They are allowed to mark to model, essentially guessing what the loan is worth based on their own internal optimistic assumptions. This creates a terrifying valuation gap between what the funds say the assets are worth and what they are actually worth. We are already seeing this gap exposed in the secondary market where distressed private credit loans are traded quietly. Sophisticated buyers are demanding deep discounts, paying 60 or 70 cents on the dollar for loans that funds have marked at par. This implies that the pension funds are currently sitting on billions of dollars of unrealized losses that they haven't acknowledged yet. If they tried to sell these assets today to pay current retirees, they would instantly crystallize those massive losses. This lack of liquidity is the single biggest threat to the stability of the American retirement system right now. You cannot sell a private credit loan quickly. It takes months of negotiation and legal work to find a buyer. In a crisis, when everyone wants to sell at the same time, the buyers simply disappear from the market completely. This leads to gating, a mechanism where the fund manager locks the doors and legally forbids any withdrawals for a period. We have seen this happen before in the commercial real estate sector, and it is now spreading rapidly to credit funds. Imagine entering your retirement years and being told you cannot access your life savings because the fund has been gated. This is the nightmare scenario that federal regulators are quietly preparing for behind closed doors in Washington right now. The exposure is not limited to a few wealthy individuals. It is systemic and widespread across the entire working class. Public pension funds, which manage the savings of teachers, firefighters, and police officers, have some of the highest allocations to this sector. They chase the yield to plug their own funding gaps, and now they are trapped in the trade with no exit. If the shadow crash accelerates, state governments will be forced to step in to save the pension systems. They will have to choose between cutting benefits for retirees or aggressively raising taxes on working families to fill the hole. This effectively transfers the risk from the private sector speculation directly to the taxpayer, just like in 2008. But unlike 2008, the Federal Reserve has very limited tools to fix a private credit crisis of this magnitude. They cannot buy these loans to stabilize the market because they are not government-guaranteed securities like treasuries. They cannot lower interest rates to save the borrowers without risking a resurgence of inflation, which would be political suicide. So the system is left to rot, with a zombie army of companies slowly dying under the crushing weight of their debt. The impact on the real economy will be a slow, grinding suffocation of growth, investment, and job creation. These mid-sized companies employ millions of Americans, and they are currently in a strict hiring freeze to save cash. As they cut costs further to pay their rising interest bills, layoffs will inevitably start to rise across the country. We are already seeing the cracks form in the labor market data, hidden beneath the headline numbers that look stable. The maturity wall is the final catalyst that will force this crisis into the open for everyone to see. Hundreds of billions of dollars in private credit loans are set to mature and come due in the next 24 months. These loans must be repaid or refinanced, but refinancing is mathematically impossible at today's much higher interest rates. Lenders will face a hard choice: force the company into bankruptcy immediately or inject more money to keep it alive artificially. Injecting more money, known as a NAV loan, is just throwing good money after bad to delay the inevitable reckoning. It leverages the fund even further, increasing the risk of a total catastrophic collapse down the road. This, leverage on leverage, is the classic sign of a financial bubble that is stretched to its absolute limit. The insiders know the party is over, and they are trying to quietly exit the building before the music stops playing. But the exits are small, and the amount of money trying to leave the system is overwhelmingly massive. This imbalance creates a rush for the door that drives prices down vertically, wiping out equity in seconds. The illusion of stability and low volatility was always a lie sold by marketing teams to gather assets. Volatility was simply suppressed by not marking the assets to market prices, creating a false sense of security. Now that the credit cycle has turned, the volatility is returning with a vengeance to correct the mispricing. The golden age of private credit was an anomaly caused by artificial zero-interest rate policies that no longer exist. We have now entered the age of consequences, where the true cost of debt must be paid by someone. The $1.7 trillion figure is likely a significant underestimate of the true size of the problem we face. When you add in the leverage and the derivatives attached to these loans, the total risk is much higher. This is a structural flaw in the modern financial system that has been ignored for too long by those in charge. We are watching the slow-motion disintegration of the shadow banking experiment that defined the last decade. It worked when money was free, but it cannot survive in a world where capital has a real cost. The losses have already happened, they just haven't been officially recognized on the balance sheets of the funds yet. When the recognition moment comes, it will shock the financial world and the public who trusted the system. But for those who have been paying attention to the math, it will not be a surprise at all. The shadow crash is not a future event that might happen. It is a process that is underway right now. Your financial safety depends on understanding the mechanics of this hidden bubble before it bursts completely. The time to ask questions of your fund manager is now, before the gates are locked and the capital is trapped. Because once the panic starts, logic and liquidity vanish from the market instantly, leaving investors with nothing but questions. We are standing on the precipice of the largest credit reset in history, and the ground is crumbling. The epicenter of this financial earthquake is not located in the high-rise towers of Wall Street banks. It is located in your local dentist's office, your neighborhood veterinary clinic, and your hospital's emergency room. These are the businesses that were aggressively targeted by private equity firms during the era of cheap money. They were considered recession-proof assets because people always need healthcare regardless of the economy. So the shadow banks poured hundreds of billions of dollars into buying up these essential services across America. They used a strategy known as a rollup, buying dozens of small independent practices and merging them into one giant corporation. To fund this buying spree, they loaded these new corporations with massive amounts of floating rate private credit debt. The plan was simple: cut costs, raise prices for patients, and sell the business for a huge profit later. But the strategy relied entirely on the assumption that the debt would remain cheap to service forever. Now that interest rates have tripled, the math behind the healthcare roll-up has completely collapsed. The debt service payments on these medical chains have skyrocketed, consuming all the cash flow intended for patient care. This is why you are seeing sudden closures of emergency rooms and drastic staffing cuts at local clinics. The money that should be paying for nurses and medical supplies is being siphoned off to pay interest on loans. We are witnessing the financialization of American healthcare hitting the hard wall of monetary reality. But the rot goes much deeper than just the high interest rates. It is embedded in the earnings numbers themselves. To get these massive loans approved, private equity firms used a creative accounting metric called adjusted EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, a standard measure of profitability. But adjusted EBITDA allows companies to add back future expected savings that haven't actually happened yet. They effectively told the lenders to ignore the current costs because they plan to fire people in the future. This allowed them to artificially inflate their earnings numbers to make the company look richer than it was. Lenders, desperate to deploy capital, accepted these fake numbers and issued loans based on fantasy projections. Now the reality has set in, and the future synergies never materialized, but the massive debt load is very real. This creates a leverage illusion, where a company claims to be leveraged 5 times its earnings. But if you use real, unadjusted earnings, the leverage is actually 10 or 12 times, which is insolvency. This deception is rampant in the software and technology sectors, another favorite target of private credit. Tech companies were valued on recurring revenue models that were supposed to be stable and predictable forever. Lenders issued recurring revenue loans that were not based on profit, but simply on top-line sales growth. This worked when the economy was booming and customers were blindly renewing their software subscriptions. But as the economy slows, customers are cutting subscriptions, and the churn rate is spiking upward. When churn increases, the valuation of a software company collapses, leaving the lender with an underwater loan. Many of these software companies are burning cash every month and rely entirely on new loans to survive. They are the tech zombies of this cycle, keeping the servers running only because the bank hasn't pulled the plug. The private credit funds are terrified to foreclose on a software company because the assets go home at night. If the developers leave, the code is worthless, and the lender recovers 0 cents on the dollar. So they extend the loan, pretend the company is healthy, and hope for a miracle acquisition that isn't coming. This extend and pretend game is being facilitated by the complex structure of the loans themselves. Most of these loans are covenant-light, meaning they have very few rules protecting the lender. In the past, if a company's performance dropped, the lender could step in and seize control immediately. Today, the covenants are so loose that the lender has no legal right to act until the company misses a payment. By the time a payment is missed, the cash is gone, the assets are stripped, and the company is a shell. This lack of protection was sold as borrower flexibility, but it is actually a death sentence for recovery rates. The recovery rate is the amount of money lenders get back when a company goes bankrupt. Historically, senior lenders could expect to recover 70 or 80 cents on the dollar. In the current private credit defaults, recovery rates are shocking the market, coming in at 10 to 20 cents. This destroys the mathematical models that pension funds use to calculate their future solvency. If you lose 80% of the principal on a safe loan, you can never earn that back through interest yields. To hide this disaster, the financial industry has built a machine to launder the risk called the CLO. The Collateralized Loan Obligation, or CLO, is a complex vehicle that bundles hundreds of risky loans together. The theory is that by mixing bad loans from different industries, you create a diversified, safe pool of debt. They slice this pool into tranches, selling different levels of risk to different types of investors. The top slice is rated Orator A by the credit rating agencies, implying it is as safe as a U.S. Treasury bond. This should sound familiar because it is the exact same machine that repackaged subprime mortgages in 2008. The rating agencies are once again stamping AOA on piles of debt that are underpinned by insolvent companies. They are paid by the banks that issue the CLOs, creating a permanent conflict of interest that has never been fixed. Pension funds and insurance companies buy these AOA tranches because they yield slightly more than government bonds. They believe the diversification protects them, but they are ignoring the correlation of the underlying risk. In a systemic crisis, where interest rates stay high, all the borrowers fail at the same time. Diversification does not work when the entire asset class is allergic to the cost of money. If the bottom tranches of the CLO get wiped out, the losses travel up the ladder to the safe tranches. We are already seeing the equity tranche, the riskiest slice, of many CLOs getting completely incinerated. This stops the cash flow to the lower investors, a state known technically as turning off the waterfall. When the waterfall turns off, the illusion of regular income payments for these funds ends abruptly. But the violence is not just happening between borrowers and lenders, it is happening between lenders themselves. We have entered the era of creditor-on-creditor violence, a brutal legal war inside the shadow banking system. Desperate borrowers are cutting deals with one group of lenders to screw over another group. They use loopholes in the loan documents to transfer valuable assets away from the original lenders. This is known as a liability management exercise, a polite term for legal theft of collateral. A famous example is the J. Crew trap, where a company moves its intellectual property into a new subsidiary. They then borrow new money against that IP, leaving the old lenders with a claim on nothing but an empty shell. This effectively subordinates the original lenders, pushing them to the back of the line for repayment. Pension funds often find themselves on the losing side of these ruthless maneuvers, watching their collateral vanish. There is no honor among thieves in a liquidity crisis. Everyone is fighting for the last scrap of value. The chaos is further amplified by the involvement of business development companies, or BDCs. These are publicly traded funds that allow retail investors to buy into the private credit market. BDCs are required to mark their assets to market every quarter, unlike the private funds. They are currently the canary in the coal mine, showing rising non-accrual rates across the board. When a BDC writes down a loan, it forces the private funds holding the same loan to face the music. You cannot have the same loan marked at 60 cents in a public BDC and 90 cents in a private fund. Arbitrageurs are spotting these discrepancies and shorting the BDCs while the private funds try to hide. The pressure is building on the auditors to force a mass markdown event across the entire industry. This is the event that will trigger the margin calls and the forced selling of assets. But who is buying? The traditional banks have retreated and are hoarding cash for their own survival. The private equity firms are fully invested and cannot raise new funds because their returns are negative. The secondary market for these loans is tiny compared to the sheer mountain of debt that exists. If 5% of the market tries to sell, prices will go to zero because there is no market maker. This illiquidity is the trap that turns a paper loss into a total realized loss. And hanging over this entire precarious structure is the involvement of the life insurance industry. Life insurers have become massive buyers of private credit and CLOs to back the annuities they sell to retirees. They are betting that the extra yield from these risky loans will pay for the guaranteed income checks they owe you. This is a dangerous mismatch. Your annuity is guaranteed, but the assets backing it are junk. If the CLO market cracks, the solvency of the life insurance sector comes into question immediately. State insurance regulators are scrambling to understand how much shadow debt is on the books of these insurers. They are realizing that the safe bond portfolios of insurers are actually filled with securitized corporate loans. This regulatory blind spot is identical to the AIG disaster that required a massive bailout in 2008. But this time, the risk is fragmented across hundreds of insurers and thousands of pension plans. There is no single head of the snake to cut off. The poison is in the bloodstream of the entire system. The private credit boom was fueled by the belief that the Fed would always bail out the market. This Fed put encouraged reckless lending because everyone assumed interest rates would go back to zero. But with inflation structural and sticky, the Fed cannot slash rates to save the zombie companies. This realization is slowly dawning on the market participants, causing a silent panic in the boardrooms. They are realizing that the business models of the last decade are fundamentally broken in a 5% world. The roll-up, the recurring revenue loan, and the adjusted EBITDA are artifacts of a bygone era. They are rapidly becoming extinct, and they are taking the capital of the investors with them. The liquidation phase has not truly begun yet. We are still in the denial phase. But the maturity wall does not care about denial. It is a fixed date on a calendar. When the loans mature, the cash must be there, or the bankruptcy filing is automatic. We are staring at a cascade of defaults that will reshape the American corporate landscape. The empty storefronts and closed clinics are just the visible symptoms of the financial disease. The real infection is in the portfolios that are supposed to support the aging population of America. As we move toward the final stage of this analysis, we must look at the endgame. How does this debt actually get resolved when there is no money to pay it? Who will be the winners and the losers in the great liquidation that is approaching? The transfer of wealth will be from the passive savers to the active distress investors, and the trigger for the final collapse may come from outside the U.S. borders entirely. The trigger that finally collapses this unstable house of cards may not even originate inside the United States. It could very well start across the ocean, where the massive Japanese banking system is currently teetering on the edge. Japanese banks have been the silent whales of the global credit market, aggressively buying massive amounts of U.S. corporate debt. Desperate for yield in a country with negative interest rates, they gorge themselves on American private credit and risky CLOs. Norinchukin Bank, a massive Japanese agricultural lender, recently admitted to catastrophic losses on its foreign bond portfolio. If these Japanese whales are forced to sell their holdings to raise cash, it will flood the market with toxic debt. A sudden forced liquidation by Japan would crush the prices of U.S. private credit loans overnight, causing a panic. This global interconnectedness means that a financial tremor in Tokyo causes an immediate earthquake in New York. It exposes the lie that private credit is immune to market volatility. It is actually highly sensitive to global liquidity flows, and liquidity is draining out of the system faster right now than at any time since the 2008 crisis. The Federal Reserve is continuing quantitative tightening, systematically pulling billions of dollars out of the economy every single month. This reduction in the money supply is like draining the water from a pool. Eventually, you see who is swimming naked. The private credit funds are swimming naked, and the water level is dropping more rapidly than they ever anticipated. But the most immediate threat to the average American is the contagion spreading to the regional banks. Regional banks are heavily exposed to commercial real estate, which is currently in a historic, deep depression. As office buildings and shopping malls default, these banks are desperately looking for liquidity just to survive the quarter. Many of them have also partnered with private credit funds, lending money to the shadow banks to boost their own earnings. If the shadow banks fail, the regional banks take a second massive hit to their already fragile balance sheets. This double whammy could trigger a wave of bank failures that wipes out small business credit lines across the nation. We saw a terrifying preview of this dynamic with the sudden collapse of Silicon Valley Bank and First Republic. Those failures were contained by massive government intervention, but the underlying rot in the system was never fixed. The term funding program that saved the banks has expired, leaving them completely vulnerable to the next major shock. The next shock is the $1.7 trillion private credit bubble bursting right in their faces. This is why federal regulators are frantically trying to force banks to hold more capital against their loans. They know the storm is coming, and they know the current seawalls are not high enough to stop it. The Basel III endgame rules are a tacit admission that the banking system is fragile and severely undercapitalized. But raising capital requirements now causes a credit crunch as banks stop lending to Main Street to hoard cash. This pulls even more liquidity out of the real economy, accelerating the defaults of the zombie companies we discussed. It is a vicious feedback loop. Fear of defaults causes a credit freeze, which in turn causes even more defaults. The only way to break the loop is for the Federal Reserve to pivot and start printing trillions of dollars again. But Jerome Powell has made it clear that the fight against inflation is not over and rates will stay high. If they print money to save the shadow banks, inflation will roar back to double digits, destroying the middle class. They are trapped between destroying the value of the currency and destroying the stability of the credit market. History suggests they will eventually choose to print money, but not before the pain becomes absolutely unbearable for everyone. That unbearable period is the shadow crash that we are urgently warning you about in this report today. It is the period where pension funds slash benefits, insurance companies fail, and millions of jobs are lost permanently. The wealth destruction during this phase will be real, painful, and permanent for those who are unprepared for it. The great wealth transfer will move assets from the indebted middle class to the cash-rich elite who are waiting. Distressed debt investors, known in the industry as vultures, are already raising billions to buy the wreckage. They are waiting for the pension funds to capitulate and sell their loans for pennies on the dollar to raise cash. These vultures will buy the companies, strip them of assets, fire the workers, and resell the pieces for profit. This is the brutal endgame of the private credit cycle. The financial scavengers feast on the carcass of the economy. You do not want to be the carcass. You want to be the one standing on solid ground when the dust settles. So, how do you protect yourself and your family from a crash that is happening in the shadows right now? First, you must understand exactly what is inside your own retirement portfolio and 401k plan immediately. If you own a target date fund, check the prospectus to see if it holds high yield or alternative credit. These are the polite, deceptive names for junk debt and private credit allocations that are at risk. You may want to consider moving that portion of your savings into short-term U.S. Treasuries or government money market funds. Treasuries are currently paying a risk-free 5%, which is highly competitive with risky corporate debt yields. Why take the risk of a total wipeout for an extra 2 or 3% yield that might never be paid? Second, be very wary of fixed annuities offered by lesser-known insurance companies promising returns that are too good to be true. Check the financial strength rating of the insurer and ask specifically about their exposure to CLOs and private credit. If the insurer fails, you are reliant on state guarantee funds, which have strict caps and massive payment delays. Third, maintain a high level of personal liquidity in FDIC-insured accounts or physical assets outside the banking system. In a liquidity crisis, cash is king because it gives you the optionality to buy distressed assets at rock-bottom prices. Do not be fully invested in illiquid assets like real estate or private funds that you cannot sell when panic hits. Fourth, pay down your own floating rate debt as aggressively as possible to avoid the interest rate trap. The same interest rate spike killing the zombie companies is hurting households with credit card debt and adjustable mortgages. Get out of the debt system before the credit lines are cut off by the banks during the coming crunch. Finally, educate your community and your family about this hidden risk so they are not caught off guard. Most people are sleepwalking into this crisis, trusting that the experts and regulators have everything under control. The experts do not have it under control. They are actively trying to hide the problem to prevent a panic. The soft landing narrative is a marketing slogan designed to keep you invested while the institutions exit their positions. Real economic data shows a hard landing is already happening in the industrial, manufacturing, and credit sectors. The freight recession, the manufacturing contraction, and the bankruptcy spike are the real indicators of the economy's health. The stock market is being propped up by a handful of AI tech stocks, masking the weakness underneath the surface. This bifurcated market cannot last forever. Eventually, the credit reality drags the stock valuations down to earth. When the credit cycle turns, equity values are always the last to fall, but they fall the hardest and fastest. The $1.7 trillion bubble is the pin that will pop the everything bubble we are living in. It is the weak link in the chain that connects the high towers of Wall Street to Main Street America. We are witnessing the end of an era of financial irresponsibility and magical thinking about debt and risk. The belief that you can borrow your way to prosperity without paying the price is dying a painful death. The price is now being presented, and it includes the accumulated interest of a decade of mistakes. This correction is necessary to cleanse the system of zombie companies and bad capital allocation that stifles growth. But the process of cleansing is painful, chaotic, and destructive to the unprepared investor who ignores the signs. The shadow crash will rewrite the rules of investing for the next generation of Americans. It will teach us again the difference between return on capital and return of capital in a crisis. Getting your money back is more important than getting a high yield on paper that disappears in a crash. The pension funds forgot this lesson, and they are about to learn it the hard way in the coming months. Do not let their mistake become your financial ruin. Take action while the window of opportunity is still open. Take control of your financial destiny by becoming your own risk manager and questioning every financial product you own. Do not delegate your safety to a fund manager who gets paid whether you lose money or not. The incentives of Wall Street are not aligned with the incentives of your retirement security. They want fees and assets under management. You want security and survival for your family's future. This divergence of interests is why the private credit trap was set in the first place by the industry. It was a product designed to generate massive fees for them and hide massive risks for you. Now the trap is springing shut, and the window for protective action is closing rapidly every single day. The signs are all around us. The PIK toggles, the gated funds, the failing insurers, and the rising defaults. You have been given the warning that the mainstream media is largely ignoring until it is too late. They will only cover this story after the crash has already happened, when your losses are already locked in. You have the advantage of foresight and the ability to act before the herd panics and liquidity vanishes. Use this knowledge to fortify your balance sheet, protect your family, and survive the coming financial storm. The storm is here, operating in the shadows, but its devastating effects will soon be visible to all of us. Be the lighthouse that sees the rocks before the ship crashes, not the passenger asleep below deck. Thank you for watching this 3-part deep dive into the hidden world of private credit and the shadow crash. If this series opened your eyes to the risks lurking in the financial system, please share it immediately. Send it to anyone who has a pension, an annuity, or 401k plan that might be at risk. The more people who understand this risk, the better we can prepare for the fallout and rebuild. Subscribe to the channel and turn on notifications so you are alerted to the next crisis signal we uncover. We will continue to track the defaults, the bank failures, and the shadow banking moves every single day. Together, we can navigate the shadow crash and emerge with our wealth, our freedom, and our future intact.